Something you don't know about Zoran Mamdani, the new potential mayor of New York City that has real estate investors and developers in New York City up in arms as there's a socialist that's getting ready to potentially be in the office of mayor of New York City. We're talking about bread lines, public grocery stores, rental freezes, and more. We've got some information you're not going to want to miss, but probably more important because we don't live in New York City is the state of the nation's housing market. We're going to bring in some new information from Harvard as well as the National Association of Realtors and some proprietary gray capital research that you won't be able to find anywhere else. Watch the whole episode. Subscribe to the Gray Capital YouTube channel. Hot damn, Matt, we got a good episode. Let's do it. Welcome back to the Gray Report. My name is Spencer Gray, host of the Gray Report, president and CEO of Gray Capital. We're a multifamily investment company, property management firm based out of Indianapolis, Indiana, joined by Dr. Matt Bosnagel,
Hello.
Director of Communications and Marketing here at Gray Capital, as well as the producer of the Gray Report. Matt, it is great to be back in the seat. I was out on assignment the last 2 weeks, although I was reporting remotely. What'd I miss?
A lot of stuff, a lot of stuff that now you're probably caught up on, and a lot of stuff that you were making happen behind the scenes. So we're kind of grateful. We're glad you're back, and there's a lot of catching up to do, I think.
There's a lot to catching up to do. First off, Matt, I mean, it was breaking news the last couple of days. New York City the Democratic candidate for mayor is a socialist. Andrew Cuomo lost the seat. Huge upset. This candidate, Zoran, is calling for rental freeze. Mm-hmm. He's calling for like a tripling of public housing investment, but other things like, public grocery stores, free buses, all of that. My gosh, is this where cities in the United States are going? Is this a playbook that's new, and did it surprise you at all?
It didn't necessarily surprise me, although I think that a large part of it was the opposition candidate Andrew Cuomo wasn't exactly the perfect candidate.
Yeah.
But there were so many people that were interested and that were passionate about Zoran's campaign, and he really captured people, and he was kind of unapologetic in what he did, and I admire that, the fact that he's not really willing to say, oh, no, don't worry about this. Like when he was asked if he was a socialist or if he liked capitalism, he's like, oh, really? I'm a socialist. It's like, if and I was making this point to you earlier, it's like in the same way that Donald Trump is unapologetic
for whatever he is.
And I think that is partly due to Democrats would paint the Republican candidate, no matter who it was, as evil, etc., and then it's like you're going to get someone that doesn't care, and then that's almost refreshing. And then here's the same thing: is Republicans will paint any Democrat, no matter where they fall on the spectrum, as the second coming of Lenin and Marx or something, as these like ultra dictatorial communist people, and Zoran more or less called the bluff, and it's like this doesn't mean anything anymore.
Well, and it's obviously what's resonating.
Yeah,
I mean, it's what's worked. I mean, it's what essentially the same type of platform that Bernie Sanders ran on. It's what AOC is getting behind. It's the only thing that actually kind of resonates in the Democratic Party. And we're going to move on from politics here in a second and talk about real estate. But it is important because when we have conversations with folks at our age, late 30s, early 40s, and younger, there's a big rift of people who don't really fully understand how markets like housing work and don't really understand why they don't have a home, they don't have any equity, and they have negative capital if you look at their student debt levels.
Perish the thought, they do understand it, and they have a different idea, and however wrong-headed we may think it is, some of the stuff that he's doing kind of hasn't really been done before, or at least there's millions of ways to skin a cat, and there's also the current system is probably closer to rent control. There's a lot more rent control in New York, so I think that both at the same time some of the stuff is a little unique, and you can't kind of categorize it into past, but a lot of the stuff isn't going to be like completely revolutionary.
No, I mean, honestly, I don't think much of what he's proposing really is new necessarily. I think the scale and the fact that it's New York City is new. I mean, yeah, New York City has had some, version of, rent control, rent stabilized apartments for a long time, different types of
Yeah, it
of
definitely
rental
is novel.
regimes.
I was even having trouble just now, just thinking. Well, it does seem like he's bringing this new thing, but it's just the volume's up on existing stuff.
And it's New York City. It's one of the greatest American cities,
Yeah.
and it's a question of, is this the direction that you could say that other cities have already gone this way, whether it's Los Angeles, San Francisco, or even Chicago, with some pretty far left policies. You'd have some people say those cities aren't in a great position right now, and they've had to reverse course in many of those cities like San Francisco.
I think that he ran a really great campaign. I really love his signs. They're really cool looking.
Yeah, no, he's too cool for us, Matt.
No, but I also, I think that it is also an illustration of a shift in the electorate, that they are willing to kind of support a candidate as far left as Zoran in New York City. I know it is not, the blanket communist, hellscape that is often described, and now maybe increasingly so by certain members of the Congress, maybe even.
Yeah.
But I also think that at the same time, there's a reason why this has kind of bubbled up, and I'm going to be very interested to see how dramatic a change it's going to be, because he's not the only one in government either. There's a lot more a more comprehensive sea change in city politics has probably got to take place in order to effectuate some of the changes he's proposing. Although maybe executive powers are very powerful in the mayoral level as well as the presidential level. Who knows?
You get the power of the bully pulpit, and you can push an agenda. But it's going to be interesting how it translates to the next presidential election.
Yeah.
If AOC ends up being a candidate or
Yeah.
a similar type of candidate. If it's the left's version of the Tea Party, which brought in a variety of further right views, some libertarian views, some ultra-conservative views, some nationalist views.
I think that's probably informing a lot of the anxiety from the Republican side is not necessarily like, oh, here falls a once great city. It's more like, well, if this is an indication of the temperature of the American voter, of where they're leaning, then they might be in more political trouble.
And so now I'm bringing it back to real estate and multifamily. I think the concern long-term for investors is policy change. And if we move away from, again, more, market rate based housing to more of a, subsidized paradigm, which again, we need all types of housing right now, whether it's affordable or market rate. But if developers become, the bad guy, and that we're discouraging development on one hand, but at the same time we're trying to build more housing, it's hard to do both of those things at the same time unless you just force it through, and then you end up building like the wrong types of housing, maybe in the wrong spots. Maybe it's low quality housing. I mean, we tried this. I mean, we went through this process in the 60s and 70s. I mean, we built public housing projects throughout the country, and that turned into projects, and they weren't managed well, and we really failed at that experiment. And so we decided we're going to do things a little bit different, bring in Section 8, Section 42, LIHTC, which has been much more successful as a public-private partnership. I think there's a lot more efforts to increase LIHTC funding, those tax credit funded affordable housing developments, or local public-private partnerships to develop more housing. But as we'll get into on the Harvard Joint Center for Housing Studies report, we've seen a huge supply of new apartments and new housing types of all kinds of housing in the past couple of years. We're seeing those supply levels recede, and as they're receding, demand is still really high, especially for apartments, as people can't afford homes. But how are we going to continue to delivering that supply?
You won't have space in New York. That's what I mean. I hate to bring it back to New York just a little bit, but that's what I thought maybe is going to be a big challenge for Zoran. First, it's like there's a lot of models you were just naming to choose from if you're trying to incorporate some kind of affordable housing policy that helps people pay rent, whether through rent freezes or whatever. There's a lot of different.
Well, I heard that there was going to be some maybe reform on air rights to allow easier to transfer air rights in New York City to allow folks to continue to build up.
Oh, okay. So so that's.
I'm just waiting for the comment section for people to tell us how we don't know anything about New York City because we really. I mean, I lived there, but short period of time.
But what you were saying too, you were talking about the active choices to put housing projects in certain places and maybe the wrong places, but also there's a passive effect of what rules and regulations, whether it's rent control rules or whatever, that basically shoves any development interests into a select areas, and some areas are marked off, and no other areas than the ones that are very, very passionately defended by the NIMBYs. I think the not my backyard and yes in my backyard, the clash between the two has never been like more legible, more noticeable and dramatic than maybe right now. I don't know. I've just been hearing those acronyms a lot.
The only good thing about those debates, the NIMBYs and the YIMBYs, the no in my backyard or yes in my backyard, is that party lines go away. Yeah. It is no longer a partisan fight. It's like the way school boards used to be, of where like no one cared about party affiliation. It's just that like, no, we don't want this development. Yeah. It doesn't matter if you're Republican or Democrat, or it's like, no, we want more development. Because if you want more development, are you on the side of the developer and the developer making money? Yeah. Or are you on the side of, housing? We want to add more, housing supply to the neighborhood. And it's interesting, affordable housing, light-tech housing, it's one thing that always interests me, it frustrates me. I don't know how to describe it, but, is it welfare for the people who are getting that, that housing, or being able to supply that housing, but really who the welfare is for the developer. Those development fees are sweet. Yeah. They are getting nice checks, assuming they do the project and check all the boxes. It's, the people who can't afford a home are getting a place to live, which is good. These developers are getting huge checks to be able to do it. So it's a win-win. It's a kind of a welfare for everybody type situation. But on the other side, you can't have one without the other is what I'm saying. Yeah, no, and I agree. I think that no matter what they use, there's going to be some private investment involved. And it will be a little bit of a public-private partnership. However, and I'm saying this with some degree of skepticism. There is this abundance agenda. It's led by Ezra Klein, and there's another author that I'm blanking on right now. But one of the things that they call out is housing, housing affordability, it's one of housing their biggest, regulation. Yeah. And one of their points is that it costs so much to build one unit of affordable housing, and I think the number was like $1 million for some of these because of you have to have the right. I think there was an example.
But you have to have all these rules that follow, and there's money
that you have to spend. They're you have to spend all that money. They're like, no, we could do it cheaper. You have to spend that money.
And it's a pretty compelling argument. I understand the counter argument, which is that these rules were all meant to be in place for a certain reason to, I don't even want to say appease a special interest. I just want to say there is a reason, and it's a perfectly logical. However, when you add them all up, you've got to figure out which ones are important and which ones aren't, and really look towards minimizing the things that are barriers. Because other than that, then it seems like waste.
I think what you said makes the most sense. Is really what are the barriers, and remove the barriers first. Do more of kind of like that negative freedom of get rid of the rules and regulations. Let developers build where they want to build, not force the costs to go up, higher than they have to be. And then you can get into how we should incentivize, because you can create unintended consequences if you incentivize the wrong way or the wrong people or build the wrong thing. Exactly. But if you let the market make some of those decisions, it's not going to be right every time. But one thing that I think that most of us, or many of us, would agree that markets, that collective thought and decision making through, millions or billions of individuals makes smarter decisions than like a centralized government of where to build the public housing project in all of the United States.
Yeah. I agree with the laws that say you can't have the building fall down, or you can't have the building so close to the river it's going to get sucked in next time it rains. There are, I think that there are thoughtful and important roles that government regulations play. I just think that you can't just say yes to all these well-intentioned rules. I think that it kind of lards up
where the line is
and contradicts what you're trying to do. So
All right, let's get into some of the new reports from the National Association of Realtors, the residential real estate snapshot. And we're going to pair this a little bit with the Harvard Joint Center for Housing Studies report as well. Matt, what were some of your takeaways? These two individuals here are talking about housing, just like us.
It's nice.
Which one is you and which one's me?
I like to be. I'm the guy that is overly emoting. I think the guy on the left.
Oh, I'm gonna be him.
Sorry.
Okay, I'll be the guy with the glasses. Okay. Anyway, economic activity. Got GDP.
Yes. A little low, not horrible, but
No.
it's still lower than maybe people are wanting it to be. And interest rates, horribly high. The graph cuts off before you get a larger context of interest rates that show them higher. But this is a snapshot that I'm using as a way to see how things are right now. And then we'll look at the state of the nation's housing and see a larger perspective over a longer period of time. But this is more current and up-to-date information than we'll see in a lot of the state of the nation's housing information. That's why I'm including it here. But then, inflation, same thing. It's a little bit elevated compared to what it was in pre-pandemic, but if you expand the context, you'll see inflation's actually relatively low, not in a dangerous position. Employment's doing okay as well.
Yeah, but I think it's important to note, Matt, that still, inflation at 3.5%, according to this print of CPI, it's certainly receded from where it was. But what has been keeping CPI elevated is housing.
Yeah.
Right? But we know that maybe not necessarily to be the case. We've had negative rent growth. Home prices are flat, maybe growing a little bit.
Yeah.
But if someone came up to you and they're like, man, there's all this like housing inflation that's going on right now, we would scratch our head because we'd be like, well, rent growth really isn't actual. We thought it would be higher this year than it was. And there was never a period since, the 2021-2022 period where we've had above trend rent growth. So it's obviously, we're this lagging indicator. That's the way CPI calculates shelter and housing costs. If we corrected for that, look at like a super core inflation rate, inflation is within target, right?
Yeah. I keep thinking of that we're in some kind of mirror or echo of the vibe session where numbers are showing okay, but then there's also a little bit of there's so much uncertainty behind that, and the inflation has wobbled. It hasn't been clearly going down. But then again, we know from the very same information we're going to get in this NAR report that home sales are down. The home prices aren't accelerating like they were.
GDP's low. It's not like we've got so hot, a cooking economy that's going to overheat.
And in that way, same too. Like the difference is a little. It's a little bit of like a distinction without a difference because we're a little worried. But the economy is not in crisis mode. It's not like it's going to go and headed towards. And I think the stock market kind of they've called Trump's bluff a few times and
hit all-time highs yesterday.
Yeah, it hit all-time highs, and
S&P.
I'm not gonna put my money in the stock market at this moment. But I do think that there is a little bit more cause for optimism than there was like in early April when the tariffs were announced.
Yeah.
But who knows?
Do you remember some of my calls about the tariffs, Matt? If you go back.
Yeah, that he would. You didn't name it taco, but I feel like...
I know, I didn't... Well, what I said was, I was like, maybe this causes some inflation, but maybe it stems some growth, actually, and slows the economy down into where people just stop making decisions to a point where it slows down activity. Yeah. And that is kind of what happened.
Oh, I think so. I think it's happened on when it comes to investors, when it comes to renters, when it comes to consumers. People are curtailing a little bit of their expenses. I think you saw that in some of the... I think that helped depress inflation a little bit.
Because we haven't seen inflation show up from the tariffs. Yeah.
But then there was also this countervailing trend of people making purchases to try to see if they could get ahead of inflation.
Yeah, in Q1.
But I don't think that these are all driven by, I think I'm going to get a raise next week because the economy's booming. I think it is all driven by anxiety and driven by uncertainty, and that's what makes it. That's just what makes it really interesting. And I'll tease. We've got our own report that's coming up, and I think that's what makes some of the predictions for the market really valuable.
Yeah, there's just so much noise. I mean, and again, we talked about in the last couple episodes with conflict between Israel and Iran. I mean, it's just like peak uncertainty. I feel like between getting through tariffs. What are the effects of tariffs? And then all of a sudden, there's this like conflict in the Middle East.
Yeah.
What could be worse? Then all of a sudden, it's like, there's no real inflation from the tariffs. In fact, a lot of the tariffs are coming off the table, or they're being reduced. We're getting to agreements with China, which was probably the biggest threat of the overall trade war,
Yeah.
as if the U.S. and China are in this prolonged trade war. But we got to an agreement apparently on rare earth, minerals and magnets, and
We'll see.
so yeah. I do think we're at we're in this teeter totter, and we're kind of at peak. Okay, I think we got things solved. Now we got to wait for the next thing to like break, or the next comment, and things are going to get flipped up because we have to, or Trump or whoever we need a little bit of volatility for some room to operate, I guess. But right now we're sitting at a point where it's like, okay, like the sun is rising. We're not in a war. I mean, we kind of were, but like we're not right now today.
Yeah.
And we're not seeing inflation today, and there's not horrible tariffs today.
Yeah.
What tomorrow shall bring, don't know. But at least today there's a little bit of relief. And so I don't know if this has been this relief rally. I mean, the Treasury yields have come down a little bit. There's even discussion of the Federal Reserve cutting
Oh, I heard.
short-term rates in July, and when that wasn't even on the table. Now, obviously, I think there was an unemployment report that was a little bit, positive, and so maybe we can't make that cut. But you talk about this vibe session. A lot of the data makes things look pretty damn good.
Yeah.
But no one is ready to, let their guard down, as they should not.
No, I agree. I think that I think there would be a good reason for Jerome Powell to cut rates, especially we haven't seen the inflation that was so, I was waiting for the empty shelves. I was waiting for pictures of empty shelves too, because that was such it'd be a good headline picture on the newspaper, but they never really arrived.
I'm surprised someone didn't empty the shelf, or they didn't take a picture during like this restocking.
Yeah. But again, this is similar to what we'll see in the State of the Nation's housing report. A lot of this is high interest rates. We got low home sales low pending home sales that were the result of these high interest rates, and just the housing market that is relatively inactive. They're building new houses at roughly the same level as before. So new listings is hovering around what looks like a long-term norm. It's not the high that we saw in 2021, but it's still very volatile. But the issue is they're just not getting built like they used to, and pending home sales and pending home sales and existing sales are also down, and you can really see where it fell, which was around like late 2022.
Well, when you say that they're not building them like they used to anymore, I mean, that's definitely true. In the next report from Harvard, they talk a lot about, a lot of the new for sale home deliveries, they're reducing overall, floor plans, lot sizes, they're smaller houses, or they have less amenities. Maybe there's not even a garage, to try to get that overall price down to make it affordable. Because as we just saw here, affordability is at pretty much an all-time low since 2016, but it's probably an all-time low.
No, it's crazy. But this is an interesting thing when it comes to sales price, and this is where I'm kind of filling in the blanks when it comes to this report and recent reports on housing and affordability is, you got high home prices, you got high home costs, you got high interest rates. At what point are we going to see a decrease in the sales price? And we could see right now it's in a temporary seasonal increase in home values, but maybe you see a softening in home price. Maybe that's what starts to come down in 2025 before it goes back up later, because it's like, I don't know where the breaking point is, because we've got low inventory already. We've got low construction, and we've got high unaffordability. There's something that, if they're not going to build any.
The only thing, we've talked about this before, and again, we'll go to this Harvard report in a minute, but the mortality of baby boomers. Basically it talked about, and basically until the baby boomers not just like move out, but like start passing away, we're not really going to be able to unlock a lot of this inventory. Just because we just have a convergence of demographics of middle age to older millennials. Peak age being 37, who are all like, I want to buy a home if I haven't bought a home already.
Yep.
Every instinct tells me I need to buy a home, get that equity. And then you've got baby boomers, who, again, those are the two largest, like, age groups, demographics, and the baby boomers are like, I'm not going to the nursing home.
Yep.
No
They're
thanks.
babies. They're babies in their name.
Exactly. They're
That had something to do with it.
Take care of me at home.
Yeah.
Take care of me at home. Get me 6 nurses.
Yeah.
And that's not going to change, and they're going to be there until they die.
Yeah.
And that's going to be a rolling occurrence. Not only going to be at once, but basically that's the like inflection wave. It's not a point. And you know that's going to be over the next 15 years or so.
Yeah. No, I agree.
But what else is it going to be because we're not going to see a ton of new inventory with rates like this, costs like this. Inability with affordability, who's going to be the buyer, you know, unless the government steps in and buys everybody a house. And, well, you know, what are 2 other industries that the government's gotten involved in that allows everybody to get a little bit of something? Be education and healthcare, and the costs of those 2 industries are not exactly palatable or affordable.
Yeah. Yeah, this is going to be interesting. I think that well, if you want to move on to the Harvard Joint Center of Housing Studies,
let's.
So we got the snapshot of and it's actually not too much different, that snapshot, than this overall 2025.
This just goes in a lot more detail
Yeah.
into a couple different areas in housing, which is really nice. And man, if you're not signed up to the Gray Report newsletter, you're missing out, because we send all these reports once a week, Thursday at 8:30 Eastern, and then Sunday you get a little digest as well. We send you all these reports.
You would already have read this.
You will have already been informed, and you've been like, I don't need to listen to this, or like this will be a good refresher. Yeah. Anyway, I really liked reading this.
Yeah.
I wouldn't say that we learned too many new things, but it put a lot of things in focus that we talk about here all the time. First off is, home prices grow along with inventories.
So this is one of the things where I would signal that the overall thesis of these Harvard Joint Center for Housing Studies, at least in the past 5 years, has always been high unaffordability, low affordability, and really showcasing how rising costs have persisted. That's been the reason why they're doing that, is because it's been true, but it also risks overstating some things and painting with a little bit broad of a brush, because I do think, yes, home prices grow along with inventories, but they are growing at a smaller rate this year than they were last year. And that's really important if you want, and if you carry that trend forward, that it could mean that we start seeing negative year-over-year declines in home prices, and that does go against their thesis, and they make a hint. They hint at it later, but I just wanted to signal that right now, and say there's some nuance, though. There's some nuance throughout. It's not all it's not all high prices.
I mean, the prices could go down, but you could get less house also if it's a smaller house. That may have to be a relatively extreme.
Yeah.
But I mean, again, this is not anything new. Barriers to home ownership rise. We've talked about this repeatedly on the Gray Report. It's very difficult to buy a home right now, to be able to basically, according to this piece, you have to be earning over $100,000 a year if you want to buy a home in the United States.
Yeah.
And that's assuming kind of just a 3.5% down payment, 30-year fixed rate mortgage. And not everyone can get that FHA mortgage where you can only put 3.5% down. Sometimes you're putting 10, 15, usually 20% down.
Yeah.
That's a lot of money.
Monthly mortgage payments rose by 3.6% in the past year. Median wages increased by 4%. Now that's actually, I had to go outside the report for that. So you would think that home affordability would go up, but it actually didn't, because there are other costs. I think it's in the next chart here. There are other costs associated with homeowner, whatever, but there are other costs, and one of them is insurance, and one of them is property taxes, and they can be a lot depending on what market you're in. The rising cost of home ownership is partly explained by steep increases in insurance premiums and property taxes, is what they said specifically. But when it comes to the amount of cost-burdened households, there has been a clear increase since, really what they're charting here is since 2019. The number of cost-burdened households, those that spend 30% or more on their housing and utilities, rose by 646,000 to 20.3 million, and now it represents 24% of all homeowner households. That's a lot, and the share of renters is close to of cost burden renters is close to 50%. So these are increasing, and it is worth paying attention to. However, in the background, like again, this is kind of, if you read between the lines, in the background, you actually are seeing lower rent growth, and you're seeing like home prices maybe not accelerate as much. Maybe those home prices start to decrease. And like I mentioned before, if home prices are up 3.6, wages are up 4, that's at least an improvement in affordability on one angle. However, on the other one, if Figure 5 does not show these property taxes and insurance things, then I'm going to be very mad. All right, see, now it's okay. Well, there's another factor, and it's insurance and property taxes. And some places, like in like Austin,
you got to take
Texas,
better notes, man. I don't know. I have to tell you, get your figures straight.
I had page numbers on like everything but that.
Yeah.
But well, whatever. Those things can be upwards of $1,000 a month for some of these,
Sure.
the utilities and the insurance costs.
Yeah. So one question I had for you, Matt, and I found this interesting because I hadn't seen the statistic or these numbers yet, and it's this concept that Jay Parsons talks a lot about. We talk a lot about, and it's that housing demand is housing demand for sale for rent. It's the same, and we've seen that affordability. For homeowners, for renters, it's gotten worse for both of those segments. Interesting statistics. The amount of number of renter households between 2023 and 2024 jumped I'm going to read this. After increasing by an average of 171,000 per year between 2019 and 2022, that's the amount of new renter households.
Yep.
170,000. In 2023 and 2024, there were 848,000 new renter households. Now, fortunately, we built a ton of new apartments over that period. If we had not had that construction boom, we would have seen rents skyrocket.
Yeah.
And we're not going to necessarily see a reversal of this trend of where all of a sudden single-family homes are really affordable compared to rentals. And so, if we're adding double, triple, quadruple the amount of new rental households that we've been adding in previous years or previous decades.
Yeah.
Again, I agree with Jay Parsons' statement. I think just about accepted fact that then housing demand is housing demand. But we are seeing a shift between folks that it's not a possibility to own a home and where you have to rent. And I see this as a really positive prospects over the medium and long term for especially A-class properties. Yeah. These newer assets that have amenities, a little bit larger, maybe a garage. But I just found that interesting. Again, just that this divergence. That's a lot more renters than we anticipated.
Yeah, renter household growth has exceeded homeowner household growth in the recent past, and it does seem like it's this case where housing demand is housing demand. A rising tide lifts all boats when it comes to housing demand. But I do think that there is a shift. There's a clear, noticeable shift, and you can kind of put the numbers to it. And it's because these home ownership costs are so high. And I would point to interest rates as being a really huge barrier when it comes to buying a home, and that's what's pushing these costs up. But I wouldn't ignore utilities, insurance. There's a lot of these things that are hanging over and making rent a lot more attractive option for people.
Yeah. Now, I will say, though, on the demand side, while hundreds of thousands of new renter households is a lot, the other major point that the Harvard piece makes is the impact of immigration on housing demand. And that immigration was, in the past, I know I'm skipping around, Matt, and I'm skipping out of your
21, I know
outline.
that page.
But we, in the past, immigration has been... So you see household growth is slowing from recent peaks. Yep. Immigration has been the primary driver for population growth in the United States. Now, you and I know, Matt, that population growth isn't the only factor in terms of a housing market. I mean, New York City has got negative population growth, but it's been a good housing market the last couple of years at least, and historically pretty good. There's slow growth markets that have been solid markets. It's relative to supply and demand, all that good stuff. But population growth certainly is a driver to household growth, and immigrant households often are renters, and so we are seeing an impact. So 840 new renter households, that's a lot, but if we have a couple million less immigrants, that's a net decline in demand in new renter households.
You got to wait 18 years for them to rent if you do it the natural way. If they move in from another country,
You ship them in.
they can rent right away.
You just import the renters.
I don't care.
Well, there's a lot of reasons.
Immigration's a very nuanced, obviously, and controversial topic, but it was supporting a great deal of population growth
Very
in the past 3 years.
pro-immigration here on the Great Report.
Yeah, and I think their point, which they make in this in this year. So I did a lot of comparing while I was getting my notes together of this year's State of the Nation's Housing and last year's State of the Nation's Housing, because it seems very similar. And I really wanted to see, all right, what's the difference? One of the differences is last year they were like, hey, population growth's going great, thanks to largely to immigration. This year it is, oh man, there's a big drop off in population growth.
Well, and that's what I think is interesting about this projection and we talked about it before that we press record, is that in a change in policy and in administration can drastically change the trajectory, and the trajectory can shift. You can do some thrust vectoring kind of mid-flight, because I mean, clearly we saw declines during Trump administration 1, and then under the Biden administration it surged back up, and then Harvard Joint Center for Housing Studies, their report last year was like, Kamala Harris is going to be elected president, or Biden or whoever. We're going to see a continuation. Immigration's no big deal. It's all very well balanced and under control.
They did not say low population really much at all in that report last year.
Because there's other declining demographics in the United States, aging. Again, we talked about the baby boomers. People are having less kids, all that stuff. Having kids later in life means just overall less kids, less compounding. And so I don't know if we can sustain this level of low immigration. I see it as more transient, but who knows? It's something to really keep track of. And this isn't anything new either. I remember when I first, a decade ago, I remember reading reports about basically immigration was going to be the long-term, really setting the trajectory of rental demand and household growth in the United States. And that remains today. It's such a loaded topic that there's not much room for nuance or really objectivity, because feelings
That being said, it does it probably has a unique impact on the rental market, maybe more than natural births, because like I said, they're born as babies and they're not born as people that rent. And I don't know if it's going to be
immigrants
like
have
all
more
at
babies.
once.
Immigrants have more babies, which is good. And they're statistically going to be renters rather than buying a home.
Yeah. So it will be interesting to see if there is a measurable impact. It shakes out a little bit differently when it comes to household growth. It's also, we're also thinking about job growth, but that's a signal that they give of this softness. And even here on in the report from the Harvard Joint Center Housing Studies, it's talking about the impending slowdown in household growth. And it's not only it's not just this general household growth. Specifically, when it comes to multifamily, there was a huge amount of apartment completions in 2024. They're comparing 650,000 to 2023's 450,000. So that's just an enormous amount of new apartments that were being built. And I do think that was particularly interesting. Oh, this map was good because first of all, I've been working on a new research report, and I made a similar color-coded map. And also, they are making the point that we've been making in other earlier research reports and in the Gray Report, that markets are diverging, and there is a big difference in some of these markets, especially when it comes to the Midwest and I would say the Southwest and the West.
I like our dots better.
Yeah, our dots, and these are size coded too, because it's similar. So it's they use the red as the high rent growth, and then there's a green, and then it goes to blue. I was really proud of myself of how I managed that little color coded, but we'll do a behind the scenes video. And
I think it's great.
Anyways, they use the same thing, and you can see how the reds and the oranges and the hotter rent growth is in the Northeast and the Midwest, and you can see how the cooler rent growth is in the West, in the Southeast. Interestingly enough, now I will point this out because I wish that I did differently. The markets that we, in our most recent report, we did Tampa and Miami, and those look like they may be some of the hottest markets in Florida, so that may have misrepresented Florida markets. However, those are some of the biggest markets anyways. But that being said, the Southeast in general is a little bit cooler. Maybe it's going to recover more faster than the West. Still, places like Austin and Phoenix, they've got a long ways to go. And Midwest is doing great. So this is noticed not just by us. Finally, it's being noticed by the Harvard Joint Center for Housing Studies, because last year they weren't really talking about this.
They finally subscribed.
Yeah, exactly. I think so. I really think so. But so they're making that point, and they're saying, and they're also, I think, implicitly or explicitly connecting it to how completions were different. They said they rose markedly in every region last year. They grew the most in the South, 36%. Or 38%. And in the West, the Midwest, they grew by 32%, and the Northeast by 24%. Still, the nearly half of all the completions in the United States were in the South, whether that's Southeast or Southwest. That's where all the building was, and I think that's probably what's going to keep the national average rent growth down. When, if you look at the individual markets, you can find ones that are well above the historical averages in the Midwest and the Northeast. So,
well, that was I got an email this morning on CRE Daily, which is it's like the second best commercial real estate newsletter out there after the Gray Report, and their headline was all about Midwest rent growth right now. And basically it's been an overlooked region for many years and kind of getting the time in the spotlight. But
yeah, so
saying that for a while.
But yeah, because if you're looking at national averages, just as is noted by this Joint Center for Housing Studies State of the Nation's housing report, you would think that everyone has built too much and rent growth is stagnating. That's their big takeaway for the nation as a whole, and there's lots of reasons. They are charting, increasing vacancy from 6.6 last year to 7.1 this year. They're talking also about the enormous amount of new apartments online. The residential mobility is going down. These population growth effects that could be in the offing, but also this is where I think it's particularly interesting. We're also at a point, so it's low demand from renters and low demand from builders, low demand from investors, low demand from all these things. We're at this weird low point, and that's where it seems like it's the fog of war is setting in, because not enough people are being active and opening their eyes and giving us an idea of what's happening. And so I feel like there could be lots of opportunities here to find things that people are overlooking with their eyes closed. But right now, it just seems like, man, things are in the doldrums. Things are getting dark. Things are getting gloomy. Yeah. It's not crisis mode. I'm not panicking, but I'm a little depressed.
Yeah, well, and these cycles can take a lot longer than people want them to. Also, and you could say that for the last couple of years, we thought that things were going to get kind of figured out because everyone wanted them to be figured out, or they needed them to be figured out.
Yeah.
Whether that's interest rates coming down, some clarity on pricing, on rent growth. People want some certainty, some clarity.
Yeah. Well, if you want to go to page 29, it's all the way much nearer to the end than I thought it was. They do have that that chart that I was looking for. I did include it in my notes. I just included it at the wrong part of my notes. It shows how much the monthly costs on the median price home when it comes to property insurance and property taxes for places like Miami, Boston, Dallas, Oklahoma City, Las Vegas, and the United States as on average. On average, you're paying, looks like $600 for property taxes and $200 for property insurance. I'm not sure. Maybe they combine that, so maybe it's $200 for property insurance and $400 for property taxes on average. But if you're in Miami, you're paying thousands. You're paying $1,400 as a whole. Most of it is property insurance. And on the flip side, in Boston, you're paying so much more in property taxes versus property insurance. So the burdens are there, and that's a lot of money. Oh man.
Boston's getting ready to toss some more tea into the harbor.
That's right. Talk about your tea party. Oh, that's funny. But yeah, overall though, like I mentioned before, probably because of these associated costs, cost burden rates are the highest. They've been. They've been increasing for the past few years, and they are increasing faster in the lower income bracket. So that's that is really, it's like supply. That's the only thing I can think of. I don't know. Maybe there is a kind of Zohran Mamdani type of plan that will get it to them for free. But in the meantime, I think maybe building more would help bring those prices down. I don't know. You gotta find somewhere to build. That's the hard part.
Well, no more federal lands. It took it out of the big beautiful bill.
Yeah, great. Maybe we
you can't build apartments on our trout streams.
Yeah. I would have liked to build a house, maybe in Yellowstone next to a geyser or something. If those are the kind of public lands they're allowed to build on, that'd be kind of nice. But whatever.
I'm sure.
But that's kind of the summation of this whole report here, or at least what I've gathered is, yes, affordability is an issue.
What do you think about this wealth effect? I don't know if this is in the notes, but home equity levels are near record highs. I mean, some owners have secured massive gains. Obviously, this is another story of the have and have nots. If you already owned a home, you've been it's been a huge benefactor to you. If you don't, you're just hanging out there, getting by, hoping that you get those free apartments and free grocery stores. There's definitely a wealth effect that's going on here. But again, we're talking about baby boomers and a handful of Gen X's and millennials.
Well, the real divergence happened it looks like at the end of 2012, and it really just trended up from there. It's nothing that necessarily has happened recently. Now the trend has increased a little bit. Maybe it's sharpened up in the past 5 years in certain places, but the real trend started in 2013, and it didn't. And that is when aggregate home equity really shot up above aggregate mortgage debt. So that means
that's the other thing.
Wealth is being built.
I mean, the fact that the aggregate mortgage debt has been relatively constant. It almost doesn't seem right.
Yeah, I know.
And you'd think that it would track up a little bit, but I mean, there's been some really strong, just linear growth of equity
and low mortgage rates, maybe. But I think that this is a kind of chart that does seem to indicate, I know there's a lot of people that say owning a home is horrible, it's a bad way, but for some people it is. And actually there was a commenter recently on one of our videos that said, yes, if you're a smart investor type, yeah, but if you're someone that really doesn't it's not thinking all the time about investing, and it's not, and that's a lot of normal, very smart people just don't have that mindset and don't have the time really to be let's make things all efficient.
Yeah.
And this will hold your money for you.
It's an investment. And again, it's getting back to the, are you allocated to capital, and thinking about, your balance sheet, the household balance sheet, and, what assets are in that asset column on the balance sheet. Yeah. And, if you just have cash, and it's not really going to appreciate. Cash is a depreciating, asset versus, a home. Traditionally, historically, that value is going to go up. Is it going to give you the highest rate of return? Is it the best investment? Maybe not, but it's doing something is better than doing nothing.
I think it's also, it locks you into this prepaid plan of...
that's where some people, again, sophisticated investors might not like illiquid investments, but some people like illiquid investments because of the limitation of it's locked up.
Yeah, you can't,
I have maybe I'm a little impulsive, or I just don't like the idea that I could be impulsive, and if I had the ability to sell it with a click of a button, I might sell it at the wrong time.
Yeah.
And so let's just lock this up. I mean, so the same thing whether it's a home or an apartment building.
Or you win the lottery and you get the payment squeezed out over time rather than all at once.
Yeah.
I think that there is... I've heard plenty of stories of people that will just spend it away, or it has been as sure a thing as it's been. Now I still think about 2008, and maybe there is a little bit of risk there, but
sure.
But it sure has been.
But even if you bought a home just before that, and you had the ability to hold on to it, today you would be you'd be fine. I mean, the
Yeah.
same thing with the stock market. I mean, even if you bought unless you bought, right in, 1929, right before the crash, or 1928 or whatever. I mean, at that period, it would have taken you longer to recover. But even at that point in time, if you had enough time, if you were young enough, you would recover and be fine. And at pretty much any other time in the history of the stock market, you can invest randomly and at a point of time. If you have the horizon, you're going to do pretty well. And the same thing is with real estate. It's just, are you allocating some capital to assets? Are you filling up that asset column of your balance sheet or not? Are you only looking at your P&L statement, cash flow coming in from wages, and what you ever spend in a month, and it's out the door? You typically, when paycheck to paycheck it's zero, you have to start putting something in that asset column at some point. And when we live in a monetary system of where dollars are depreciate by design, your wages are being paid in dollars, and your wages are growing at or below the rate of inflation. Well, it's even more important to be allocating to the asset column that is going to outpace the rate of inflation. That's the whole game right there. It's simple as that. You get some assets that are going to appreciate, and your wages are going to just kind of cover the day to day.
Yeah. So there, like I said, there is some benefit to ownership for sure. I think that those barriers have made that made a lot of people unable to enjoy those benefits. And so I think that the increase in renting population, relative decrease in home ownership population, probably is due more to they aren't able to buy rather than they don't want to buy.
But here's the difference between some, call it young people, I guess, that are in a situation where they can't buy a home. And you can either, it's a classic glass half full, half empty. You can say, well, I'll never be able to achieve the American dream. I can never buy a house. I can never get that asset because the only asset I can think of is a home. Or you can say, look, I can start accumulating assets right now. I can go on Robinhood and I can start buying stocks. I can just start buying an index fund, and I can start putting some of that away. And it may be a little bit, but that grows over time. I mean, got John's over here. He's buying
locking
stocks
in that 15% gain or
he's
whatever.
He's locking it in. And he's like, look, I don't have the capital to go and buy an apartment building or a house right now, but you can still stack gains and stack assets at an early age, and it compounds over time. And every person, it doesn't matter what you're really starting with, everyone can start allocating at some point. So a lot of this is mindset and mentality and education. Done a really bad job educating society and youth about investing, about finances or anything. I didn't learn anything about this in elementary school, middle school, high school. That's changed a lot with the way we get our information and the way, again, society is going. As bad as meme trading could be, and crypto, you can have good or bad opinions about it, but it's made a whole subset of people aware of investing. For the good or the bad, whether it's they see it as gambling or they actually see it and understand it as investing or not is yet to be seen, but at least there's a chance.
Well, the best we can do is give people a clear view of the future. Maybe not only of the housing market, but maybe specifically multifamily. And that has really motivated the upcoming report that we have, and we're going to give a sneak preview here if it's not already published in the interim, predicting the future of multifamily. And I hinted at this before. I think that we are in this uncertain, but I would say consequential moment in the economy and the multifamily market, and we wanted to help people find where and when to find those strong multifamily markets. Now, what's going to happen in the future? And
so this is the crystal ball.
Yeah, this is, and I worked.
This is the tea leaves.
Yeah, we worked with our data scientist. I call him data scientist John Chapman. He built this model that factors in vacancy, job growth, and supply growth. And he also worked on supply growth itself and then factor that in to predict rent growth. And we get an idea of these. We picked 10 select markets, but we also did some national numbers that you can see here that show that rent is set to recover as supply goes down. But it's a lot more nuanced than that, because the factors that are the weight or the power of vacancy, job growth, or supply is going to be different for each different market. And like I mentioned before, when we were talking about the State of the Nation's housing report, there's a big divergence in some of these markets, and it's not just a flat. You can't really look at the national numbers and find an accurate number for your own specific market. You're going to have to do your own homework on that.
The only thing that I think the national numbers are really beneficial towards is understanding sentiment, investor sentiment, and then also a trajectory on CPI and inflation.
Yeah.
With again housing being a third of a component of CPI, if you have an idea of where rent is going, but again you have to keep in mind that it's such a lagging indicator that we've had years of negative rent growth and it's still positive on CPI.
And the broad trends in the national are present in the individual markets.
True.
But it's just like you're going to see some huge variation. So there's a spike in deliveries, and then there is a pullback. Well, you're going to see a spike and pullback in all of these markets, but some are just crazy, and some maybe don't even have that spike or don't have that pullback.
Well, some markets it's not dramatic because they didn't deliver as much as other markets, and so there's just not as much to pull back from. Like a lot of these Midwestern markets, there's a little bit of a surge, but they're coming back to kind of norms, and so it's not as dramatic versus some of these Sunbelt markets that were up here, and now it's... Yeah,
just to highlight, though, this uncertain moment, it is, we have the previous challenges. We've coming off of 2 years of, if not more, of low rent growth and high expenses for apartment operators. We've got these looming loan maturities that are a big problem to a certain specific group of apartment owners and operators. You've got this, the economic uncertainty, high interest rates, and we're caught between this wave of newly built apartments and a sharp drop off in apartment construction, and rent growth is low. So we can hope for the future. We don't know what's going to happen, but we know in the past it hasn't been that great. So things are so cloudy, and I think just in the same way as there has been relatively little purchasing of apartments in the past few years, so it hasn't been great for price discovery. I think in the same way this year for renters, they haven't been as active in they've been doing new renewals, and maybe that's kind of hurt rent growth is what's kind of, it seems like it happened, because there's just been this similar stagnation in this year as it was last year, as it was the year before. So we looked at things, like I said, vacancy, job growth, and apartment supply, and we've charted out how these individual markets will perform, and a little bit you can imply or infer how regional performance has been based on some of these figures.
Yeah, Kansas City, at least in this selection of markets, Kansas City's taking the top spot of projected rent growth for 2026, at least in the second quarter of 2026. The Great Capital Report is saying Kansas City is going to be growing rents by about 3.5%, followed by Tampa, Florida, 3.2%, Miami, 3.6%, and Seattle, Washington, 2.68%. Indy 2.59, then Philly 1.5, Columbus 1.35, and then in the negative, Denver negative half, Austin negative 1.25, and then Phoenix negative 2.4. That's rough. They've got a lot of supply still coming online. I mean, that's the direct. It's not an immediate correlation because again, there's other factors, but certainly a big impact. The markets that have the least amount of the most supply are seeing the largest declines. Yeah, but Tampa and Miami, a good amount of supply is coming online, and they're still growing.
Top 2 and 3. Well, and that is a lot of that is due to job growth. And if you want to keep scrolling here, and we've got these. Got a little bit more details for some of this stuff here. Just starting with Austin, the story there, and because we don't have job growth listed in the graphs here, so what you're seeing is rent growth and supply growth. Now the line for Austin is still negative, but it is recovering really quickly so it's recovering basically from negative 5% all the way up to negative 1.25. So yes, it's still negative. Rents are still falling in Austin, but the speed of that fall is a lot a lot weaker. It is almost implying that maybe it's going to get to positive quicker than you might think because of the really strong job growth. I will say though, one of the suppositions that that John and I have been making while we are working on this is there a threshold of new supply that makes it so that there are different rules about it. So and I would say, and this is just a back of the napkin thing, is if it is growing by more than 1%, the supply each quarter, it seems to put it in a different category of these like ultra high supply.
So 4% a year or 1% a quarter puts it in a different category. That's when the high supply starts really impacting.
In a different way. And now I would have to look to John to see, but this is something that we kind of tested a little bit, and
it's good. It's good to know. I mean, just for the future, you start seeing that the new supply relative to existing inventory go above 4%. You might start seeing some declining rent growth. That's a good back of the napkin.
But regardless, Austin is not going away. It's got such huge job growth that it could overcome even that. So I think that with close to the highest job growth in the country, continued demand will drive that recovery. And we'll just have to see for Austin. Columbus, Ohio, similar. It's got pretty decent job growth, but it had a little bit more of supply. And we can skip around here. If you have another apartment that you want to look at.
What market did you find interesting?
Indianapolis. I think Indianapolis is just it looks so good.
So is this a good sweet spot or what?
Yes, I think it's a good sweet spot. It's actually in a good spot. It's got low supply growth. It has elevated job growth. It has job growth that can compete. Now, I have a tab open on my computer that shows the job growth of all 10 of these as lines, and I'm looking and I'm isolating. And it's over the 3 years that we look at in this coverage, it's competing. It's competing with your Phoenixes sometimes, and it's not Austin, but it's above a lot more than you would think. And so with that strong job growth, you got low supply growth, you have rent growth increasing. The difference between Indianapolis and Kansas City is that even though Indianapolis has larger job growth, it has a little bit more elevated vacancy that has depressed our rent growth projections relative to Kansas City. So that's just something about the existing market conditions in Indianapolis. That's what vacancy represents. But yeah, again, like that, this is the exemplar for me of Midwest stability is. It doesn't have to be a perfect market in like going off fire, but if you've got decent, steady job growth, and if you have a supply that's manageable, then you're going to see good rent growth, and that's what our projection is. It's 2.59% rent growth projection, which is up considerably from where we are right now. The updated version of that is going to have the two rent growths side by side.
Oh, wow.
But this is just what we have here in the preview.
and I think it's worth noting that, again, markets have different submarkets with different rates of growth. I mean, you're going to go into the suburbs and you're going to see much higher rates of growth rather than in Marion County, Indianapolis proper.
And then if we want to scroll down to either Miami or Tampa, because I mentioned those earlier. So Miami is it is so indefatigable. It's like an immortally. There's nothing can budget.
It's like the hammerhead worm.
Yeah, exactly.
You keep chopping it up.
It just grows 5 more hammerhead worms. But yeah,
which is frightening, by the way.
Yeah, I know. I think that I've seen this. I think that if you grind it with your shoe,
you have to, right? Anyway.
Yeah. So Miami has its supply. Now, I was talking to John Chapman about this as well. I was like, what is the X factor here? And for Miami and Tampa, you can kind of group it together because it has had relatively high supply, higher than the Midwest, but it has had rent growth arguably higher than the Midwest. Right now, it's 3.16. It's higher than our projections for Indianapolis because the supply is so exceeded by, there's just not a lot of places to build, or they're not building as much in Miami. Also, retirees are boosting demand more in Miami and Tampa, and those aren't reflective in the job growth. So that's led to our.
Well, they've got the new alligator Alcatraz that's going online outside of Miami, so maybe that's a little surge in population as well.
Oh man, data centers and detention centers, I guess. These temporary boosts in employment.
Miami's got its own thing going for it. It always has.
I remember saying this even like every year. It seems like we're tracking all these. Everything moves crazy, but Miami just does its own thing and it does it well. It's
party in the city where the heat is on, Matt.
I guess.
All night on the beach till the break of dawn. So I mean, I don't think Denver has that song,
Yeah,
song about
yeah.
it. I mean,
No, but Denver is a good example though of
Rocky Mountain High.
I thought that's Colorado. Yeah.
Yeah, Denver.
Yeah.
Mile High
All right.
City.
Yeah. Okay,
But I
good.
mean, it's
got a
a different vibe though.
Well, and when
A
it
little
comes
slower
for our projection, yeah, it is slower moving, and this is one where you had job growth that wasn't high that can't be that countervailing force to the supply growth that it's had. So we've got negative 0.5 for our rent growth projection, even though the supply isn't like huge. It's not like it's getting 10% supply growth or anything like that, but still the job growth just was not enough to supply to kind of bolster the demand.
Denver was a great market, but then it got high.
Yeah. That's true. Legally and structurally when it comes to their housing. When it comes to their multifamily housing.
Denver's a good town.
Yeah. And so that basically summers. I don't want to give away too much about this report, but we do have
Where do I get this report? This is great.
So you go to www.graycapitalllc.com/future. So if you want to know how to predict the future of multifamily, you go to future. And I want to move from that future to a little sharper look at the present for the and actually if we want to move to the apartment list report, it has a really good this does seem like doom and gloom. Like I said, it's going to be so regional, but this is more of the same, more of the indication of a cool down in the multifamily market when it comes to rent growth. Rent growth currently is at 0.2%, and last year it was at 0.4%. So this is less than we need it to be. And I'm sorry, what was the other? So rent growth month over month is down, and rent growth year over year is still negative. I think it's negative 0.7% if I'm not mistaken, and that is still lower than it should be. And also vacancy is as high as they've measured it. So this, I think, of all of the reports that we get regularly, whether it's Yardi Matrix or RealPage or Redfin even, Apartment List has had the most pessimistic, or I mean, if you're a renter, the most optimistic take when it comes to affordability. They say that rents are going down. They say that rents are not filling up as much. Other sources, RealPage has charted improving occupancy. So I just want to signal that there is a degree of disagreement among these data sources. That's why I think, though, that Apartment List is valuable, because it's saying this thing that's a little bit of an outlier, and I don't want to miss the Minority Report. I want to know what happened from all these perspectives. And I think that there is a certain amount of validity to this Apartment List thing, because we've been seeing so much building. You can't build the most you've ever built, like they said in the State of the Nation's Housing, and not expect there to be an effect there. So what I did just want to signal here: you've got your high vacancy, you've got lower than normal rent growth, but you also have a large amount of regional variation that you can see in the map they have farther down in the So you can see still room for recovery in the Southeast, but Midwest, Northeast, doing very well. Really, along the South, just as was said in the State of the Nation's Housing, you still have monthly and yearly rent changes. So that's where they built. That's where they built more than half of all the new apartments were in these southern markets. And I'm not sure I don't think that that's balanced with the population. I'm pretty sure that there are more people living in the places where they didn't, but that's, I'll have to check that. I'll have to do the math there. But still, you're getting huge variations here. So metros with the slowest rent change, negative 6.4 for Austin, negative 4.7 for Denver. And then the metros with the fastest, the greatest year over year rent change, San Francisco at positive 4.9 and Chicago at positive 4.1. So that's a huge swing, man. You got like 5% and then negative 6%. That's a big difference, and I don't think that these differences didn't crop up all at once, and they're going to be playing out for the rest of the year. Before things probably get into a more normalized, probably a little more even next year. But
what was that report we were looking at last week, Matt, that had Silicon Valley broken out as a top market?
Oh gosh, I forget.
It just reminded me of just how
maybe it was Avis and Young. Yeah, it was the Avis and Young report where all of their key markets were individual suburbs of Silicon Valley, Chicago, and Boston.
Yeah, it would be like us having like Indianapolis and Greenwood and Carmel,
Yeah.
and then select a South Sunbelt market and LA and Albany.
That's something that to be able to quantify this, it's something that I would like to chase down maybe in future reports, is to see, is there a way to look at all, put it in the spreadsheet and see, is the regional or market to market variability, how great is it now versus how it was pre-pandemic, how it was, and love to see how that shakes out.
Jay Parsons had interesting episode recently on his podcast and talking a little bit about how what were considered to be the absolute core markets.
Is this the contrarian?
Yeah. San Francisco being one of them, and New York City. Now they're considered much more like risky markets and like a very much contrarian plays.
Yeah.
Whereas again, those were the safe bets. And for a big capital, it's like sure, go buy an apartment building in San Francisco. I mean, the rents were crazy. It was continuing to grow. It was such a great city.
That's what I'm thinking.
But now it's
with
like
Zoran
who's the
Mamdani.
crazy? Yeah.
Someone's going to make a lot of money. Some people are going to be moving out of New York and saying, oh, I don't want to invest there. There's someone that's going to make a whole lot of money building all the apartments that people need.
True.
And same thing with San Francisco. It's just a numbers thing. There's going to be someone.
The question is, though, I guess, is New York entering a negative cycle of where starting in the 70s, it had to grow out of kind of a pretty dark place. And, different mayors kind of with peaking at, Bloomberg of where it kind of got better, where it's hyper clean, very little crime. And then, things have just kind of deteriorated post-COVID. And the way we saw San Francisco transition from a really nice, clean place to some place that you didn't really want to travel, really bad issues of homelessness, open, air drug use, etc. Maybe that's just the meme and the stereotype. But New York City, is it going to be a more dangerous place all of a sudden and a less desirable place because with free housing and free food. What does that attract? And does that necessarily produce a prosperous, wealthy society, or maybe not a great outcome?
Maybe I'll live and eat there if the housing and food are good. I think that's it.
Yeah, that's the point. Not.
I
get what you pay for.
Well, but I also think there is and this is something that you mentioned earlier, is an emphasis in a growing amount of investor interest in the smaller cities, in the secondary markets. I think it was John Chang a few weeks ago talked about how the cap rates between the secondary and the primary markets are starting to, the gaps between the two is really shrinking because more people are just paying attention to places like Indianapolis versus New York.
When Kansas City, Columbus, and Indy are the new core markets, we'll take it, but it's definitely a change of conversation and if that is where the conversation is going, it's certainly a big change from the last couple of years.
Yeah.
And institutions are just now, we've been talking about this for years, Matt, right?
Oh.
Institutions are just starting to wake up. And they're having to place capital. And all of a sudden, I'm just saying it now, over the next, not even this year, over the next couple of years, there's going to be all these really hot takes about how these emerging developing markets in the frontier of the Midwest are emerging, and no one else has heard of these places, and they're like, oh, I've got a really interesting, I was in Indianapolis the other weekend. Just wait for that. Just wait.
Have you heard of this place? It's called Kansas City.
Kansas. Yeah. I don't even know what state it's in, to be honest.
That's good.
Yeah. Okay.
But,
yeah.
Keep going. Keep tuned in to and we will be publishing, if we have not already, at graycapitalllc.com/future for our own research report.
Well, it's going to be published when you hear this because we're talking about it on the show.
Yeah, that's true.
So we're going to have to publish it.
Yeah. And,
so last minute edits, we will get them done. No, but it's a great report. It's one of the first reports with, we've been upping the amount of our own analysis, and this is the first report where it's pretty much entirely Gray Capital proprietary statistical analysis that you and John have been working on. And it's not just, in the past, a lot of our research briefs, we're taking a lot of different sources, aggregating that data, and then doing analysis on that statistical research and data. Now we're taking, raw data, doing our own statistical analysis on it, making our own assumptions, and then also doing the analysis. And so you're not going to be able to find this anywhere else. It's coming from independent source. Call us biased, for Indianapolis, I guess, and we're out there trying to buy apartments, raise money from accredited investors to buy apartments, whatever. We can only do that effectively with good information. And so we're trying to put some good information out there, and we'd like to share it with you for free. We're not even charging for this, Matt. Just big mistake.
GreatCapitalLLC.com/future. Predict the future.
Futures now. At GreatCapitalLLC.com/future. And sign up for the newsletter while you're at it. Subscribe to the Great Capital YouTube channel. And if you are an accredited investor, you're going to want to look at the website as well, because there's going to be a new Great Capital deal coming out in the next couple of weeks. It's in Indianapolis, A-class, beautiful property, suburban. It's a little less than 300 units. We've got a really interesting value add plan, even though it's basically new construction. We're getting in it. Basically, we're buying it for, listen to this, Matt. Okay, we've talked about supplies coming down, right? It takes a long time to build a new apartment. You gotta get the land. You gotta entitle it. The zoning's got to be right. You gotta all this work. It takes 2-3 years to build an apartment building. And they're not building any more of them. You can't get the financing. If I could tell you, you could snap your fingers and you could build it. It'll be delivered in 60 to 90 days. And you could do it for a price that's cheaper than you could actually build it for today. You're going to get it at, call it a 10% discount to what you could build it for. And it's going to come delivered leased. Fully leased. Fully leased.
Where can I sign?
Fully leased, Matt. You'd be like, this is incredible. That's essentially what we're doing. We're buying a stabilized asset, pretty much brand new construction, 2024 construction, suburban Indianapolis, 119% population growth since 2010.
It's a great growing area.
$97,000 individual median income. 134 median household income. There's only one new apartment that they're going to build over the next 5 years that we are aware of. This submarket was absorbing 150 to 250 units a quarter, but they're only going to build less than 300 over the next several years. It's an incredible opportunity.
We've been really, as much as I've been talking about this report that I did, and that this new deal is occupied.
It's exciting. It's awesome.
That's what I'm really thinking.
So again,
today.
We can't spill all the beans right now. We're going to be under contract soon, but you can get in touch with us now. We can talk about it. We can share a little bit of information. It's really exciting. And it's, again, you're either in two camps. I'm not making any decisions right now. I think the whole world's going to end. Suns will not come up tomorrow. Or you're saying, this is pretty simple. You buy low and you sell high. And we're at a low point right now. It's very simple. Fundamentals over the next 10 years are locked in. Fixed rate debt, 5-year hold-ish.
Makes sense to me.
It's what we do. Okay, we'll catch you on the next one.